Passport booklet supplier NexG's, formerly known as Datasonic Group, saw its shares jump by over 30% in recent weeks, bolstered no doubt by the new 6-year 1.73 billion ringgit contract it secured from the Ministry of Home Affairs. This comes right after its shares experienced a dramatic slump on August 11th, plunging by as much as 31%. The reason? A stunning acquisition that has left investors, analysts and market watchers asking one simple question. What on earth is going on? The trigger for this market shock was NexG's announcement that it had acquired a 32.61% stake in Clasita Holdings for 60.31 million ringgit cash or 15 cents a piece. That's a staggering 87.5% premium over the market value of the shares just a day earlier. On top of that, NexG also bought 414.31 million units of Clasita's warrants for 16.47 million ringgit, taking the entire price tag to 76.78 million ringgit cash. To put this in perspective, NexG's total cash and bank balances stood at just 61.6 million ringgit. The purchase price wasn't just higher than its cash reserves, it was almost double its short-term debt. It's a truly mind-boggling decision, especially since Clasita is a struggling company, a former lingerie manufacturer that has now ventured into construction. Following the deal, Clasita was renamed NexG Bina and it appointed former Inspector General of Police Tan Sri Razaruddin Hussain as its new independent chairman. And now, it is selling off parts of the lingerie business, currently its non-core assets, to fund property projects. It remains to be seen whether the move will help turn NexG Bina around. Back to the acquisition. This deal isn't a standalone event. It's the latest in a series of complex and interconnected transactions. The Clasita shares were sold to NexG by Hong Seng Consolidated, a company that by the end of the deal booked an estimated disposal gain of over 34.5 million ringgit. It was just as hard to fathom the rationale behind Hong Seng's purchase of the Clasita shares 2 years ago. The web of transactions extends beyond this one deal. Over the past year, NexG has been on an aggressive acquisition spree, spending over 180 million ringgit in cash. This includes a 40 million ringgit purchase of a 51% stake in Innovative Holdings and a 9.53% stake in MMAG Holdings. This is where the story gets even more intricate. These deals involve a tight-knit circle of individuals. For instance, Tan Sri Khairul Adib Abdul Rahman, a former Director General of the Public Service Department, became NexG's largest shareholder shortly before the Clasita deal. His connections also extend to MMAG, where he is a former chairman. This pattern of key players moving through various companies raises significant questions about the underlying rationale for these high-premium acquisitions. Now, NexG's recent contract win has secured its core business for the long term. This raises a critical question. Will the company continue its strategy of acquiring businesses that appear to lack synergy? If so, is this an evolution into a more sensible strategy, or does it remain a high-stakes bet? As assets and liabilities shift in this complex high-stakes game, the ultimate question is, who will be left holding the assets and the liabilities when the music stops?